Hey guys, I'm Karunya Rao, and in Ideas for Profit, all eyes on Axis Bank's Q2 earnings, which showed the bank as a winner in terms of asset quality but lagging in growth. The granular deposit base and capital cushion provide the arsenal for growth recovery as the economy improves. In the meantime, Axis is leaving no stone unturned to be future ready, spending aggressively on technology as well as manpower to fortify market share. The stock, meanwhile, has underperformed both the Nifty as well as the Bank Nifty in the past 3 months. But we see Axis Bank as a long-term winner that stands to close the valuation discount with peers as caution gives way to optimism and execution. Core margin performance was muted. Margins declined on account of excess liquidity and dominance of secured assets in the book. While core fees grew decently driven by retail fees, lower trading gains dragged down the non-interest earnings. Operating expenses shot up on aggressive hiring, technology spending, collection expenses and so on and so forth. The kicker in profit after tax came from moderation in provision on much improved asset quality, both in terms of slippage and restructuring. Asset quality picture was much better with net slippage at 707 crores, which is a sharp reduction from 3,976 crores reported in the previous quarter. Relatively lower gross slippage along with higher upgrades and recoveries resulted in lower reported gross NPA at 3.53% and net NPA at 1.08%. Provision cover was maintained at a healthy 70%. Axis Bank threw a positive surprise with a minuscule restructuring of 4,342 crores and a very tiny quantum of 119 crores yet to be restructured. The restructured book has a high provision cover of 24%. Close to 65% of the book is retail and 93% of retail is secured, and the unsecured has been fully provided for. There has been a reduction in below investment grade book on the corporate side as well. The positive trend on asset quality is a result of the early caution and superior underwriting. However, that resulted in reported growth look unimpressive compared to private sector peers. The overall loan book grew a 10% YOY driven by retail and SMEs, whereas the corporate book was flat. The book nevertheless is increasingly de-risked. Close to 80% of the retail book is secured, and there's a conscious effort to lend to higher rated corporate and SMEs. The high quality is getting reflected in a low ratio of risk-weighted assets to total assets that has fallen by 200 basis points sequentially. Axis Bank's superior liability is reflected in the competitive cost of funds at 3.87%. While the total deposits grew by 18% YOY, low-cost CASA on a daily average basis grew faster and its share remained stable sequentially at 42%, but marked an improvement of 200 basis points over the year-ago quarter. We see Axis Bank coming back to growth trajectory as macros improve, as evident from the recent pickup in disbursement. The bank is sitting on excess liquidity of more than 85,000 crores. Should this wane with return of growth, it would impact interest margins positively. Margin should also get support from the steady improvement of quality in deposits, uptick in share of high lending like unsecured, and decline in the share of rural infrastructure development fund bonds, currently 4% of balance sheet that carries a negative spread. The bank is spending aggressively on technology and manpower, like I said, to take on competition from incumbent as well as new age players. With a comfortable capital adequacy ratio of 20.04% with CET1 ratio of 15.81%, Axis Bank is suitably placed to gain further market share. Of course, a key risk to watch out for will be unexpected future disruption because of COVID, resulting in poor growth and substantial worsening of asset quality. Even without factoring in value of the subsidiaries that could be a meaningful value driver in the future, the stock at 2.1x FY23 adjusted book trades at a discount to larger private sector peers. We see the valuation gap narrowing with the return of growth.